Hey everyone, my name's Andy. I'm from Finding Value Finance. I'll be your host today. We've got Calvin with us, who on Twitter you've got it's Calvin Friage, I think. Is that how you pronounce your last
Calvin
name?
Froedge.
You okay? And you talk a lot about commodities, shipping, stuff like that. Could you go
Right.
through a little bit on your background, kind of what you talk about, and stuff like that?
Yeah, well, like I grew up in Kentucky and my family did automation mostly for commodities processing. So, I kind of got very early exposure to commodities, machining, industrial stuff. So that's probably why I kind of gravitated towards this corner of the market. Um, in 2016, I moved to Panama after doing some traveling in Latin America and deciding that I wanted to be here for mostly for tax reasons. And I run a shipping data service called Marhelm. We cover shipping, commodities, day rates, fleet positions, fleet composition, analysis, that sort of thing. We recently did a report on the offshore market. We're working on a report on the chemicals market right now. So, kind of generalized commodities and shipping. And then I also run my own book, which is mostly energy, shipping, mining, etc.
So right now, if you're to kind of look across the financial markets and commodities and all that stuff, what are you seeing today? Are you seeing recession, slowdown? Do you think commodities are going to accelerate, inflation, all that stuff? Kind of where's your mind at when you look at the entire markets right now?
Yeah, I mean, we've got what the Fed said today that they still want to push towards this 2% inflation target. So we've still got elevated inflation. We still have historically low unemployment rates. Rates on a historical basis aren't that high, even though people think that it's the end of the world when the 10-year goes above 5%. So I think we've got an environment kind of similar to the 1970s. There's a lot of uncertainty. There's a lot of inflation. There are a lot of possible, supply shocks. We might have multiple recessions, but if we were to have a recession now, it'd be kind of odd having a recession at full employment, right? So I think that you've got kind of data points all over the place. I mean, there are some signs of distress as well. Regional banks, credit card delinquencies are very high. I think highest ever. You've got credit card delinquencies, mortgage delinquencies, auto delinquencies all going up. So there are some signs of stress, but I think that those signs of stress are more about affordability than general economic health, right? I mean, a lot of people bought at high prices, and now that anything that's variable rate, with prices going up, they're finding that they just can't afford anymore. So I think that you're going to have to see prices of a lot of assets come down, but that doesn't necessarily mean that we're going into a recession. I think kind of broad view. That's my general take on the economy as a whole. I was just recently at some machining shows in the U.S. and everybody I talked to there, other than slowdown in automotive, medical is slow. People kind of said, things are strong in every vertical. The one thing that I've been talking about a lot and been telling people that they should really pay attention to is Treasury issuances from the Fed, Treasury issuances from the Treasury Department, and whether or not the Fed is actually buying that debt. So, over the next couple of years, you've got, if you look at the maturity waterfall, it's kind of like, facing the wall in Game of Thrones. Like you look straight up at it, right? It's gigantic. And that's basically U.S. debt, sovereign debt, maturing over the next couple of years. So in order to pay for those maturities, the Treasury has to issue trillions and trillions and somewhere on the curve over the next few years. So I don't see how that doesn't push yields up. And if the Fed's not buying it, then I don't see how it doesn't push yields up a lot. if you also take into account, the fact that we're running a $2 trillion deficit year to date, so that deficit this year is probably going to be 2 trillion. I don't know how it's going to be any smaller next year. In this first week of the war in Israel, they spent $10 billion, and we've said that we're going to support Israel. We're going to support Ukraine. We've already sent hundreds of billions to Ukraine. We keep adding new programs. There's, basically they're doing a soft bailout on commercial real estate. At least, the Treasury's trying. The administration, the executive branch is trying to do that. So, I don't see spending coming down. Pretty much all the GDP growth. I think Stanley Druckenmiller said the same thing. We don't really have, GDP growth without the deficit spending. I don't see that the deficits are going away until the market actually forces the Treasury to live within its means. So I think until something breaks, then there's still going to be a lot of kind of cream coming out of the fiscal. And if the Fed turns around and says, okay, well, we achieved our goals, we're going to start, buying Treasury debt again, I think you get really high levels of inflation. So, it's like if the Fed doesn't do anything, then we're probably going off a cliff. But things are strong right now, partly because of the deficit spending. If the Fed goes and starts buying debt again from the Treasury, then you better own miners, you better own real assets, because all that stuff is going to the moon.
What makes it going to go to the moon? Is it the inflation? Is it the interest rates? Is it the rotation of money from financial assets to hard assets because of interest rates? What's your opinions around there?
Well, if the Fed starts buying, right now the Fed has decreased its balance sheet by what, 10% from the peak? About 10%.
It's something like that.
Yeah. So, and we've seen significant tightening of the general financial environment since they started that. That's just 10% drawdown on the Fed balance sheet, right? So it might not even be that high. Maybe it's only 5%. Maybe I'm thinking of monetary supply. But anyway, if they reverse that and they go back into the kind of money creation that we saw after COVID and during great financial crisis, then I'm saying that nominal and real inflation and the money supply, they're going to grow a lot. And the only thing that's historically been able to keep up with high levels of inflation and growth of monetary supply have been energy, precious metals, coal, direct inputs into things that don't really have much economic variance in how much of them we can use, right? I mean, the Fed can't print oil. The Fed can't print gold or silver or copper, right? And, we were also in this environment where we've got a lot of threats to the supply side for a lot of those commodities, right? I mean, you've got a bunch of Arab states right now saying that they want to do, maybe not the leadership suggesting, but elements of the leadership suggesting that they do a full embargo. Iran's leadership is saying that, right? So we saw an embargo in the 70s, right? That's what led to the Strategic Petroleum Reserve being created. Oil went up 20-fold from 1970 to 1980. Gold went up about 15x during the 70s as well. I think even more than that at the peak in 1980, I think was the peak. So I think if you look back historically and you wanted to compare today to any other decade, the 1970s is your playbook.
And why is that the decade to compare to? Is it the same fiscal issues? Is it the inflation? Is it the response that commodities had to inflation? Like, why choose the 70s?
Well, geopolitically, very similar. You've got multiple wars going on, multiple expensive wars that we're involved in. So those are, putting a strain on the fiscal side, just like in the 70s. And then a lot of the commodity producers are, they're kind of getting to the point of going on jihad, against kind of U.S. Hegemony. So I think that's just kind of got the most parallels. I mean, if you look at World War II, going into World War II, things were quite a bit, different than they are now. And we were fighting, nation states, right? We had a completely different kind of class of people. I mean, the debt to GDP ratio, and at the end of World War II is similar to what it is now. So the 70s is the only comparison that I could come up with, but I think it's a lot worse than the 70s. You've got the same kind of geopolitical instability. You had them going off of Bretton Woods, so there was monetary instability, right? I mean, that was really the trigger that led the Arab world to start nationalizing assets. Was they were trying to keep the price of oil artificially low. So what that was doing was giving people in the West a better standard of living, while keeping the producers kind of, where they were having, real losses in their purchasing power, because the cost of, getting the oil out of the ground, wasn't decreasing. And, foreign companies were keeping a lot of that profit, right? So that was really what led to that wave of nationalizations in the late 60s and the early 70s. Then we unpegged from gold, and gold immediately went from $35 an ounce, I think, up at the highs it hit almost $1,000 an ounce, right? So if you look at what we're doing now, we've got the same kind of monetary repression. We've all heard the claims of tomfoolery in some of the big commodity banks, commodity exchanges. COMEX Gold, COMEX Copper, London Metals Exchange, right? So we've got all the same types of financial manipulation that are, it's trying to be used by the powers that be to keep some of the prices of these inputs down. But then you have, a big kind of pushback against that. You have central banks buying gold, which in levels that they haven't done in a very long time. You've got producers that are starting to focus on giving returns to shareholders over investment. So, starting to prioritize their own needs, the needs of their shareholders above the needs of the state. Because let's face it, you and I, as investors, commodity investors, we don't need cheap commodity prices. That doesn't benefit us, right? Who needs cheap commodity prices? Consumers of commodities, right? So consumers of commodities are trying to keep those prices low. I mean, even China is doing that, to a big extent, with their own using their SPR to manage the oil price recently. But we used our SPR bullet. China's using theirs right now, and after those big SPRs are depleted, who else is gonna keep the price of oil down? The demand hasn't slowed down. We got record high demand last year. We've got record high demand this year. We're going to have record high demand next year, right? So, that to me, that's sort of the big theme is that the reason I compare it to the 1970s is because the geopolitics and the eventual unwinding of these commodity pegs, right? Those were the elements that dominated the 1970s, and I think those are the elements that are going to dominate the 2020s.
So knowing what you know about what's coming, how would you position yourself? What sectors do you think possess the best returns, or the best maybe risk reward or potentials out there, after viewing what you think could potentially be coming?
Yeah, I think energy and commodities. I mean, commodities kind of broad. It could be everything from agricultural commodities. I mean, look at the price of orange juice. Look at the price of feeder cattle, right? So there's kind of very bullish spots everywhere. Look at the deficits that you're seeing in copper and silver, even in platinum, which is the price has been going down, right? So you look at the kinds of draws you've seen on oil recently. Kind of global drawdowns. The Iranians have used all of their floating storage. Like I said, the U.S. we shot our SPR bullet. The Chinese are working through theirs now. So I think pick just about anything in that entire kind of energy commodities complex, and don't pay too much for it, get a good yield on it, and then just kind of hold out because they can't print that stuff. The other thing I would say though is the dynamics of what the Treasury is doing. Um, it does have a very deflationary twist to it. Okay, so here's the thing: if the Treasury needs to pull $20 trillion out of the monetary system, which only has about $20 trillion in the next 3 years, if the Fed does not become accommodative, right, then we could see the Treasury, collapse the U.S. banking system, collapse a lot of things, right? The dollar could be very strong because the treasuries can be sucking dollars out of the system. And in order to do that, yields are going to have to keep going up to attract those dollars to treasury bonds, right? So that is that I would also suggest to people that they keep a lot of cash, right? And that they keep cash in a lot of different places, because I think it's very possible that we could see a whole lot of bank failures. We could see real monetary instability, and we could see extreme dollar strength. So those are your kind of two big scenarios, I think. Either the Treasury, sucks way too many dollars out of the system to fund the huge deficits, and they're basically completely short the front end of the curve, right? If you look at what's maturing over the next 3 to 5 years, it's kind of a disaster. So, most people, myself included, think that no politician in the Western world, and no bureaucrat in the Western world has the stomach for a collapse, right? You know, Everybody thinks there's going to be some sort of inflationary way that shifts. What they really need is higher taxes to fund the deficit, fund the debt, etc., right? And so there's two ways that you can tax people. You can either put taxes on earnings, right? I mean, after World War II, top marginal tax rate went to 96%. So you can either put taxes on earnings, or you can have a silent kind of monetary tax, where inflation itself is the tax, and you're using that to reduce the level of indebtedness. So I think a lot of people think that they're going to go with the latter. The other complication there that I want to point out is that a lot of the obligations that the Treasury now has are obligations that are going to increase with the with any money printing, right? So people's Social Security payments, if there's high inflation, those Social Security payments are going to lose value as well, and they're going to have to raise the Social Security payments in order to keep up with that. So I think that the direction skews heavily towards the inflation scenario. If as long as the Fed eventually kind of shifts its policy to accommodate the Treasury. But the path that we're on now, I mean, we're going straight. We're the Titanic going straight into the iceberg, and Janet Yellen's driving us.
Sure, we haven't already hit it, and we're just taking on water.
Could be. It could be. But if that is the case, yields are going to go a lot higher, and like I said, you're going to want to have a lot of cash. So I really do think that cash widely dispersed, as like, you're hedging against two things, right? You're hedging against deflationary collapse, monetary collapse from kind of these absurd Treasury dynamics, and you're hedging against inflation, which is basically the only way to avoid that collapse, right? Like, we're either hitting a wall, or we're gonna at the very least try to issue the Fed's going to buy just enough debt that they don't collapse the system. The monetary supply is going to have to increase, right? The issue is, over the last couple of years, the Treasury, they just kept increasing their obligations, so that the growth in the monetary system didn't help the Treasury, get out from that. Um, I think it's heavily skewed towards inflationary risks, but um, who knows? This might be the time that the Fed says, enough's enough, and they let the fiscal go into the iceberg, and everybody dies. Right? This could be it.
Could they have both? I know that sounds weird, but could they cause a panic, get the demand for their bonds from the panic of a recession collapse, drive demand into the bond market, and then afterwards they say, crap, it's not going to work, and
I
then
don't
they
I
throw
don't think that there's enough money in the system to fund the Treasury's obligations over the next 3 years.
like period.
Like period. Yeah. Like I literally don't think there's enough money in the system.
So then they're going to have to create it. They're going to have to create
Exactly.
it if they
Yeah.
want the system to survive, uh, the current system
I
to
mean,
survive.
because you
Period.
have to think about, where is all that money going? How much, look at all of the things that banks have on their balance sheets, all the mortgages, people have to have money for, making those payments. Banks have to have enough cash on their balance sheet to cover deposits. Deposits are a liability for a bank, right? So it's not like all the money can go to the Fed, or sorry, all the money can go to the Treasury, right? The That money is needed in other places in the economy. So, just look at the maturity profile over the next 3 to 5 years. It's unprecedented. We have never seen something like this ever. The Treasury has never been this short the front end.
Almost like they did it on purpose, huh?
Could be, yeah, could be.
Um, anything else that you'd like to share? I know you have to go at some point. What else would you like to share? Whether it be commodity related, financial topics, anything else that you'd like to share with the viewers?
Unless you got specific questions, I don't have anything else that I really want to cover.
So to sum it up, commodities, companies that I noticed that you mentioned something about dividends or some sort of return. Is that
Yeah,
what you
like
favor? Mhm.
absolutely. So, I've kind of got maybe a different, assessment of risk than most people do. Some of the companies that I own the most of right now are state-owned companies and companies in really questionable jurisdictions that have their own armies. So, I am looking for kind of uh, if I don't think that if I think I'm gonna make less than 20 or 30% on something, I'm not interested.
You mean total return or in dividend yields alone?
I'd hope yield alone.
Okay. So you're talking like Petrobras and stuff like that.
Petrobras, Ecopetrol. I've been buying
Yep.
Sibanye Stillwater recently.
Ah,
I did really well with the tankers. Those yields are still going to be huge.
yep.
I don't have really taken my exposure down there, but Hafnia, for example, I got an average of 50% yield uh, annually on my purchase price, plus 300% appreciation. So, that's really what I'm looking for, is something that, the thing about, commodities that I love is that earnings are lumpy. And people are always the most pessimistic when there's no earnings, right? So what I look for is companies that have that don't have a fixed dividend. They have a variable dividend, 35%, 50%, 75%, 80%, and some of the shipping companies it's even 100% payouts. So if you buy when everybody's pessimistic and there's no yield at all, there's no dividend, and then you just hold it for a couple of years. Usually these companies aren't about to go bankrupt. I mean, they're usually not in terrible fundamental shape. They're just not making very much money. So then you just wait for things to get a little bit better. And so Sibanye right now, I'm buying it at $5 a share. They paid $3 in dividends in the last 3 years. So, a lot of people are kind of bearish on platinum group metals right now, but there has been a lot of supply rationalization this year, especially. And, if we go inflationary again, I think platinum group metals do fine.
Okay. They'll do fine. And what's cool
Yeah,
about that is these commodity producers, if they're paying a certain percent of their free cash flow, and their cash flow goes up substantially, your yields on your original purchase price blow to the
they're
upside.
insane. They are absurd. I mean, in shipping, mining, refineries, oil producers, those are the only sectors of the market where you can buy something and then a year later you look back and you got paid 50%, 100% back in dividends. Right. So
Which
that's
is
why I play
ridiculous.
in this area.
What's that?
That's why I play in this sector of the market because I feel like it's the most it's the most emotionally priced sector of the entire market. Like people will take a company, like Apple or Microsoft, where they view it as having stable earnings, and look at the kind of multiples that they pay. They'll pay 30x, they'll pay 40x, right? I mean, they're Amazon, they pay even more, right?
Mhm.
And are those really kind of every eventuality proof businesses? I don't think so. What happens to Apple if China invades Taiwan? I bet you it's got 70% downside risk. What's the probability of China invading Taiwan? I'd say it's might be a coin flip.
Okay. So I think we invest very similarly. I like the dividend payers as well. And then when I look out into the future, you have to take the mindset of I'm not investing today, I'm investing for the future payouts over the next 5 years. And if oil were to go to 120, 150, 200 plus, whatever, wherever it ends up going, those dividend yields just blow out. And
Right,
and
exactly.
it's like a diarrhea of cash flow right into your account.
Yeah, I mean, even at $70 or $80 oil, you're still getting 10 to 20% from Ecopetrol and Petrobras. And
Yep.
people talk about nationalization risk on those companies, and I'm like, well, I would be more worried about nationalization risk of a private company than a company that's already nationalized. I would be more worried about having a company that has assets in a jurisdiction that could nationalize those assets, which is exactly what happened to a bunch of the American oil producers during the 1960s and 70s, right? I mean, I think it was Exxon recently had some assets in Africa that were nationalized. And unless Exxon is willing to send an army in, they can't do anything about that, right? So to me, when people talk about nationalization risk, it's there, but they're putting it on the wrong companies, right? They're assuming that the national oil companies, the state-owned companies, have higher nationalization risk. They are already national companies. What the nationalization in some of those state-owned companies has been over the last few years is share buybacks because they were so fucking cheap. That was the most reasonable thing for them to do with their cash flow, right? So that's how those companies are going to get nationalized, is the state realizing that there is literally, that because their shares are so mispriced and the yield is so high, there is literally no better thing that those companies can do with, and those governments can do with their cash than reinvest in those businesses.
I gotcha. I gotcha. So I know you have to go here pretty soon. How do people follow you? How do they reach out to you if they're interested in your work?
Okay, so my company, the research company, is Marhelm Data. So Marhelm Data on Twitter, or we just put out a new YouTube channel as well, Marhelm, where we're summarizing some of our interviews that we do, because we do interviews like this with mostly with commodity producers, shipping companies. Sometimes we'll get engineers, technical guys in to we just did one on nuclear energy, for example, with a nuclear engineer. So we have the YouTube channel, we've got our Twitter, and then we have our paid subscription service and Discord, where we have trade log and discussions and that kind of thing. I also have a newsletter, Calvin's Thoughts. That's on my Twitter bio. The link to that, and I usually do one post a week, updating either something I've done recently, somewhere I've been, a company that I think is interesting, a trade I did, something like that.
I'll put that all in the description link below when I post it,
Cool.
if anyone's
Yeah.
interested. All right, thanks for coming on, Calvin. I really appreciate it.
Thanks for having me. I appreciate it. See you later.
Mhm.